Hi, everyone. Welcome to this week's market update. So this week, I want to talk about a theme that we've been discussing for the last several months, and that is the resilient economy. So last week, we got the jobs report for the month of May, and it showed that the labor market continues to be very resilient. In fact, we've seen over 350,000 jobs being added to the U.S. economy over the last 2 months. On a 3-month moving average, we're looking at 190,000 jobs being added every month. So for context, that means we are seeing the most job growth on a 3-month basis since we've seen in 3 years. So for all of these concerns about labor displacement as a result of artificial intelligence, we're just not seeing broad evidence of it just yet. This means that companies, broadly speaking, are still hiring. So definitely a good sign. As we shift our focus to data that we're scheduled to receive this week, our focus really turns to inflation. We're going to get a lot of good information this week as it relates to inflation in the U.S. economy. It starts on Wednesday with the Consumer Price Index. So here, consumer prices, the headline figure, as we call it, which includes food and energy, is expected to be up 4.2% from last year. What that means is price levels, including food and energy, are expected to be 4.2% higher than they were this time last year. For context, the Fed has a 2% target for inflation. We're more than twice that. And this is all the more relevant today because we are recording this on June 8th. Yesterday, June 7th, marked the 100-day anniversary for the start of the war in Iran. So inflation continues to be top of mind. It's making the Fed's job very, very difficult right now. So we'll see where this data ultimately comes in. That'll be followed by the Producer Price Index the following day on Thursday. So a lot of good inflation data coming this week. And then next week, the Federal Reserve Open Market Committee is meeting to discuss monetary policy. This will be the new Fed chairman's, Kevin Warsh's, first time leading a FOMC meeting. So the pressure is on. There's going to be a lot of eyes on this. They are not expected to make any decisions there, but it's really going to be interesting to hear how they're viewing this current environment. We know that inflation is still an issue. And with the strong economy, the strong job market, it really makes their job difficult. And so because of that, we have seen that expectations for the next policy move have actually changed quite a bit in recent months. Now, we came into this year and the market was expecting between 2 and 3 rate cuts coming after 3 rate cuts last year. So they were expecting a few more this year. So the equivalent of about 75 basis points of cuts. Now, as time has gone on, we've seen the war cause a spike in energy prices. We've seen a resilient economy. We have seen expectations have actually shifted in the other direction, where now expectations are for the Fed's next move to actually be a rate hike. And so last week on June 4th, we saw that expectations were for approximately 1 hike of 25 basis points between now and the end of the year. Expectations increased a little bit more following that strong jobs report that came on Friday, June 5th. So this is what we're looking at right now. What does this mean when it comes to the market and the impact of higher rates on the equity market? I think it's really interesting to note and worth highlighting that the S&P 500 broke the streak of 9 consecutive weekly gains last week with a decline of about 2.5%. Now, the weakness here was really caused on Friday and led by a sell-off in technology stocks. The technology sector on Friday lost about 6%. And if we look a little bit more deeply at underlying performance, we see that the semiconductor index, what they call the SOX, actually declined about 10% on Friday alone. Now, you need to go back to COVID and the dot-com bubble bursting to see one-day performance of 10% or worse in the semiconductors index. So really that tells you that it was quite concentrated in terms of the sell-off. And sure, a lot of it I think can be justified because we've seen such strong performance across semiconductors, across the broader artificial intelligence plays. But I think what it speaks to for the investor is that in this environment, you need to maintain diversification. And that's what we are doing across client portfolios. We say that you can have conviction in the artificial intelligence theme. You can certainly play it in a number of ways, but don't get over your skis. We will see volatility here. We expect to see rotation beyond just these technology plays going forward. And I think that diversification is going to be key from here on out. Now, before we wrap up here, I'll just highlight the other thing that's on our radar this week is the fact that SpaceX is scheduled to go public on Friday. That is June 12th. In case you missed it, we recorded our views on the SpaceX IPO in last week's market update. So please be sure to go and check that out if you haven't seen that already. And I'll look forward to talking to you soon. If you have any questions, as always, please don't hesitate to reach out to your advisor.